does. It's not good for me.
That's what I'm afraid of.
The fixed rate, Voya has been, well, I don't know. I think they said the minimum is 1.5, I'm not sure what we're paying right now. But the minimum on the one we're leaving is 3.5, so it's gonna cost me quite a bit.
Yeah.
Because at this point, again, I know I could make more money in the stock market, but my husband is a riverboat gambler with his investments, so I figure that's enough.
It balances it.
Yeah, it balances out if I don't take any more chances.
Waiting for the blinding light. Waiting for the blinding light.
Actually,
Yeah, so
it's a lot now.
there we
Right
go.
there. There it is.
There it is.
Now, good morning, everyone. It's 10 o'clock, so we will call the November 14th, 2024 meeting of the Oklahoma City Employee Retirement System to order. Item number 2 on our agenda this morning is to approve the minutes of the meeting of October 10th, 2024. I have a motion and a second. Please record your vote. Item is approved. Item number 3 is a presentation from Amundi Pioneer. Jason, you want to kind of give us a lead in?
Sure. As we talked about the last couple months, due to turnover at Western and some regulatory issues there, we've made a recommendation to consider other candidates to potentially replace not just Western, but Brandywine. And Amundi Pioneer is a multi-sector fixed income manager that really covers the gamut in a more dynamic way. They can allocate where they find relative value. So we've invited them in today for your consideration, and so they're here to present.
Okay, thanks.
So good morning, and thank you for having us, and thank you for the opportunity to be here. And we are very happy to be here and welcome the potential to manage a portion of the retirement system's assets. So just quick introductions. I'm Katie Wormington. I'm a relationship manager at Amundi, and I would be the primary point of contact for the retirement system. With me is Jonathan Scott, who's a portfolio manager on the strategy and the deputy director of our multi-sector fixed income team. So a brief introduction on Amundi, and then I'm going to turn it over to Jonathan to talk about the portfolio. Amundi is a global firm with more than $2 trillion in assets under management, of which the U.S. Contributes $114 billion. I do importantly want to note that in July, we announced that Amundi US, the U.S. business of Amundi, will be contributed to Victory Capital Management, and Amundi will take a 26% ownership stake in Victory Capital. Most importantly, there will be no changes to the investment teams as part of this transaction. So I just want to reiterate, no changes to the investment team are expected, and we are looking at a 1Q25 close for that transaction. We have been keeping ACG, Jason, and the team well informed and will continue to do so as the transaction progresses. Victory has a model where they have investment franchises underneath them. They have 11, we will be the 12th. And we will be an investment franchise with no changes to that investment team that you're meeting and that Jonathan will talk about today. So I'm happy to answer any questions about the firm, but otherwise I want to make sure we give Jonathan time to talk about the strategy.
Okay, thank you. Good morning.
You all. Morning. Yeah, so if we can move to slide 5. We'll go one, yeah. Just to reiterate, with this transaction, we'd still have research agreements and sharing agreements with Amundi because they value our U.S. research as much as we value their European research. And the value proposition that we offer is really being a part of a large-scaled asset manager really gives us the breadth and depth when it comes to analyst resources. But being smaller in the U.S. allows us to take those resources and apply them to a portfolio in a concentrated way that allows for, in the multi-sector process, appropriate diversification, but really allows us to also generate security selection, to not have it all be diffused away as you would get with some larger U.S. peers where they're forced to make their money through larger macro trades. You know, our bread and butter is more at the security level, at the issuer level, and that security selection helps generate the performance and also makes a much more repeatable process from our perspective and a much more durable process as well. If we go forward one more slide. We operate as a team, so while I'm here, it's not just me. We work as a team. Our process is very collaborative and collegiate. It allows also for durability in the sense that no one person is key to the process continuing, for the performance continuing. Our years of experience are pretty tremendous, with on average more than 30 years for a number of the managers, but we're also developing some junior people, some younger people as well to really reinforce. But we're all working towards the same goal. We're all working towards the excess and outperformance of the portfolio relative to the benchmark. We're all seeking and paid based on that performance. So there is no incentive for individual people or analysts or anyone to be sector advocates, because their compensation doesn't change based on how much money, so to speak, they represent within the portfolio. How we all get paid is ultimately how the portfolio performs at the end of the year. And that really gives us the incentive to go where value is best served. It also, because we work as a team and we're not thinking about things in isolation, it avoids the risk of unintended consequences. We might like energy, but if you give your money to an investment grade portfolio manager or high yield portfolio manager, they could also like energy. You can find yourself with duplicated risks, redundant risks within the portfolio. And the reality is, if you like that trade, you want that exposure, there might be one or two places to go that's best compensated for that risk. You know, if you're at the buffet, you don't need investment grade, high yield, Norwegian krona, or some other factor that gives you an oil or energy exposure. Instead, we can think the best value might be in high yield, or it might be in investment grade. It depends on what the value proposition is. It might be in securitized based on equipment for oil field services. So it's really about thinking about it in a holistic approach and going to the spaces where we think there's best compensation, but still having everything be value-driven, be fundamentally underwritten. That really allows us, in the case that we're early, unfortunately because we're value investors, I think also because we're bond managers and we tend to be a bit nerdy, we always get to the party early. That's kind of a curse of us. But the reality is, if we've done our job, we've done the appropriate underwriting, with our longer investment horizon, 1 to 3 investment horizons, we can be a little bit early and it can still be a very positive experience. What we don't want to do, and what we don't do in our process, is rely on correlations or covariance matrices, because we want exposures that are primarily tied, for the majority of the portfolio, to the U.S., to U.S. growth. So even if we go off benchmark into securitized credit, the reality is the collateral there is still a U.S. borrower. It's still houses or homes in the U.S. or auto loans in the U.S. And the ultimate performance of those securities will be borne by, is the U.S. growing or is the U.S. going into a recession? When you get into some of those more quantitative trades, whether it's between us and Europe or us and Japan, you can have permanent impairment. You can be wrong, not because Japan defaults, but because the U.S. exceptionalism, just U.S. outperforms the rest of the world. U.S. outgrows Europe. U.S. outgrows Japan. And that dynamic doesn't have to mean revert. And that's, from our perspective, there can be opportunities for those global trades. There can be opportunities for those macro trades. But you should also be aware of the risk that if it goes against you, just adding time to your investment horizon doesn't mean you're going to get your money back. You can have permanent impairment, you can have permanent loss of capital on those trades, even though you didn't experience a default. And so I think if we go forward, let's skip forward to slide 9. And this is where we think about the construction of the portfolio, thinking about, is the value there? Are we being appropriately compensated for the risk? Can we fundamentally underwrite this so that in the situation where we're early, as long as we add time to our investment horizon, it can still play out, and also be able to re-underwrite in the scenarios where something might go down further and add more in those down environments, but still have an appropriate amount of diversification in the portfolio. So when we have high yield or we have investment grade corporates, we're not buying just a slice of a high yield fund or a slice of an investment grade corporate fund. We're buying individual credits that we think are appropriate for this strategy. So it doesn't mean we buy all high yield. And for different multi-sector strategies, depending on the risk tolerance of the client and the objectives that money is serving, you can have clients that invest in high yield but might only want BB rated, higher quality high yield, or that you might have some that are much more risk seeking and want the full spectrum. It's really, from our perspective, we don't have to own all of high yield. What we're looking for are the individual credits that will outperform, that have a reason to exist, that have a way to outperform the benchmark, and we can forget about everything else. We're looking to pick the winners. And I think what you hear oftentimes amongst credit managers is avoiding the losers. And as multi-sector, we don't care about the losers because the losers are so small that you don't notice them anyway. It's really about picking the winners. But when in bonds specifically, making sure we buy them and that the bond itself, the structure of the bond, allows for price appreciation. We can jump forward, actually. I'm sorry, we're going to skip all the way around here. If we jump forward to slide 20, when we think about sector allocations and exposures, the reality is we had a lot of downgrades during COVID in March 2020. We had a lot of what we call fallen angels. Ford got downgraded, Occidental got downgraded, Synovus got downgraded, amongst others. And those credits we thought had a reason to come back to being investment grade. They had a reason to exist. They had a reason to be investment grade. They had a capacity to come back to being investment grade. And their bonds, given the structure, given that they had investment grade structures, also had meaningful potential for price appreciation, where not only do you get the yield, but if they get re-upgraded, you can get 10, 20 points of excess return on that upgrade. Whereas for most high yield, it's more of an allocation decision. It's not, when we think about where to get security selection, where's the richest hunting ground, so to speak, for security selection, you want to be in cohorts where you have larger dispersions and you have a capacity for meaningful price appreciation. And for a large part of high yield, that's not the case. BB high yield for the most part is more of an allocation decision. But as we think about it and we take that more concentrated approach, we can go into credits that give us that good upside, that give us that opportunity set, and we can still manage the overall risk of the portfolio. We can put on some hedges to dampen the volatility of the portfolio, even if we're not necessarily crazy about having a ton of risk in the portfolio. We can still dampen it, but also have securities that generate excess return, that generate security selection. Unfortunately, if we go forward 2 more slides, we've been able to do that repeatedly, pretty consistently, generate decent excess returns on a yearly basis without, we've had some good years, but even our down years historically haven't been that down. So pretty consistent over any given year and also over a longer investment horizon. But if we go back 1 slide, where we find value right now is actually in treasuries. Because where investment grade spreads are, we haven't been at this level of richness since 2005. We have been richer historically. You'd have to go back to 1995 for valuations to get tighter. But in 1995, we had the fall of the Soviet Union. We had, in theory, a geopolitical honeymoon, which I think we all agree we don't have right now. We also had 6.5% GDP growth in the U.S. back in the 90s, and we don't have that right now. So I think from a valuation perspective, we become a little bit more defensive in our positioning on a go-forward basis, but still being value investors, we think the best value, the most attractive part of the market right now is actually in treasuries. And that the rest of the credit market, while there's opportunities here and there, we've been actively reducing that risk. We've been growing our treasury position. We've been growing our cash position. And we've been overweight five-year treasuries and really underweight 20-year and 30-year treasuries. I think that's one of our higher conviction views at this point, is that regardless of who's in power in Washington, we still have deficit spending. And I think we can all agree, even though there was a red wave here in this last week, we're still going to have deficit spending out of the federal government. And we can debate about where nominal yield should be, either higher or lower. I think most people would agree, though, given our deficit spending at the federal level, that the yield curve should be steeper, that yields for 20-year and 30-year treasuries should be higher than for 5-year treasuries. And given the flatness that we have in the curve right now, that there isn't much compensation, if at any compensation, for taking that extra volatility for going out the curve. And so, again, just thinking about our process and where we're positioned and moving the average quality of the portfolio from a BBB minus up to, we're BBB plus right here. We bounce between BBB plus and A minus. So we're at the higher end of our range. And it's really just making sure that our overall investment process is consistent. If we go back a couple of slides to 18, you'll see that we have guardrails on this portfolio. we have flexibility, but there's still guardrails. We still want this to be a core fund, core bond strategy. So the duration is going to be bounded around the benchmark. It's on average, even if we go into high yield, we'll still have an average quality of investment grade in this portfolio. We can do some currency, we can do some EM where we find it opportunistic, but for the most part, it's still going to be a US-centric. The majority of the exposure is going to be US-based exposures, whether that's in securitized or in the corporate side. It's still going to have the factor of US growth in it that drives the ultimate performance of the strategy, but it does allow the flexibility to go into these other spaces. But we don't want to have a position or get into a position where we've gone so far off the reservation that we end up with too much risk in the portfolio. We want those guardrails. We want some constraints, and we can operate within those constraints and still generate meaningful excess return for the portfolio and outperform the benchmark, but just have it be a little bit more bounded and have that be a part of our process. So, think about the macro considerations. Where should we be from risk? Should we be overweight risk or underweight risk? Where there are sectors that we find attractive that have, tailwinds or sectors we should avoid that have headwinds, and then construct it and have it be an overall portfolio that at the individual level we like, but then still be able to run it through the various quantitative tools. We use quantitative tools to act as, again, guardrails or guideposts to perhaps highlight, the risks that we all think we're already taking. But we don't want those quantitative tools to dictate where we go within our investments. The overall investments still need to be underwritten. We still have to have a value-based approach. We still have to have a positive view on those credits. And the structure of those credits, of those individual investments, have to be such that we can mitigate the downside risk and also get a more symmetrical upside opportunity on them as well, given the overall nature of the portfolio. But I'm happy, I know we're constrained for time, I'm happy to pause there if there's any questions.
What's your overall outlook for fixed income in general today relative to a couple of years ago?
I think U.S. fixed income is very attractive because, look, we have tremendous growth here in the U.S. There's a reason yields have gone higher. And I think the yields were going higher since middle of September because the odds or probabilities of Trump re-election were growing over that period of time. And we all saw what happened in 2016 after he got elected, where yields went higher. But also U.S. growth is really outstripping the rest of world growth. And so for U.S. fixed income, as Europe cuts rates, as Canada holds or cuts rates, as China continues to have their own domestic growth problems and they have to cut their rates, that just makes U.S. fixed income on a relative basis that much more attractive. And we've seen that pretty consistently over this last year, particularly from Europe, where a lot of, for them, defined benefit pension plans have been coming to the U.S. market and continue to come to the U.S. market to immunize their risks, where they're trying to hedge their risks. They don't have as deep of a 20-year, 30-year market over there, so they come to the U.S. for that diversification to lock in the yields because their funding ratios are so strong. But that technical and that demand, I don't see changing anytime soon, particularly as the rest of world yields continue to be depressed as their growth stagnates and ours continues on.
I have a question. If you'll go to slide 20.
Yep.
I guess I'm a little confused on the negative 13% credit market spread hedges. I take it you're shorting that area, but if there's a negative side, should there not be a positive also on the top side to add up to 100%?
No, so that's so that is a derivative, so it doesn't have a market value exposure. We've shown it here as a notional exposure to clearly communicate the size of it. But what we've done is we've invested in high yield rated securities, whether that's in securitized or in the high yield market that we think offer an interesting opportunity set, an excess return potential. But again, we don't want all the volatility that comes with that investment, so we've added this hedge on place to dampen the overall volatility of it. Now, as some of those credits have performed, we've been reducing that hedge, but it's not because we've necessarily become more bullish on valuations or the economy. It's because some of our investments have played out, and as we've sold those investments or they've gotten upgrade to investment grade, we've also reduced the hedge to reduce that pair trade. But what we don't do in this portfolio is we don't use leverage. So in the few cases, so back in 2020, where we went long that credit hedge, we have to fully fund that with cash and or treasuries. So we can't have a position, we can't end up in a position where you have your portfolio fully invested in corporate securities, but then we also went long 20% of this hedge to give you like 120% exposure. We're using this, we can use it on a pair to hedge, but if we want to go the other way to go long, we can't use it as a form of leverage. So it helps. So you want to think about it paired versus the U.S. high yield, the emerging market, the international high yield, and parts of the securitized sections. That's what the offset is against.
Okay, I can understand why you want to do it, but I just don't understand why it's represented this way, so. But
Because there's a few ways we can think about risk. We just find the clearest way to communicate risk for parts of fixed income is with a market value exposure. So the hedge technically doesn't have a market value because it's a derivative. So if we showed, so all the cash bonds that we show here, all the sectors above that line, those are all cash securities, so that their market value is their value. But the credit market hedge, because it's a derivative and it clears every single day and you settle your variation margin every day, it technically doesn't have a market value.
so it technically doesn't have market value, but you're showing it in essence as such on this graph as minus 13.
But we're showing it as minus 13 because that's the notional exposure for it. So we want to show that we be clear in our position, clear in our exposures that we're taking in the portfolio, but also showing that that negative 13% on a notional exposure is offsetting the 12% that we have in U.S. high yield, the 6% that we have in international high yield, and the 10% that we have in emerging markets.
Okay.
We try to be, I think, conservative in our reporting so that we clearly communicate all the exposures, all the risks within the portfolio. If we also jump forward to slide 25, just so we have a little proof in the pudding. When we think about security selection here, it's a bit of an eye test, and I apologize for it. But when we're thinking about security selection, we're judging, how did the BBB rated industrials in the portfolio perform relative to the BBB rated industrials in the benchmark, or the BB rated industrials versus the BB in the benchmark, so that any security selection we have is already accounting for a down in quality bias or skew that we might have that I think is common amongst most active managers. So when we generate security selection, it really is on a ratings for ratings basis, and those are securities that have outperformed their rating. And by outperforming the rating doesn't necessarily mean they got upgraded. It just means that through their yield and also through a change in their fundamentals, their valuations changed and we got price appreciation.
Okay. Anyone else have any other questions this morning? All right. Well, thank you very much. We appreciate you coming in and
Thank you for your consideration. Thank you for the
Present to us.
opportunity.
Thank you.
Okay, moving right along. Item number 4 on our agenda is the consent docket. We can take that with one motion, please. We have a motion and a second. Please record your vote. Item is approved. Item number 5 is to ratify approvals. We have a motion and a second. Please record your vote. Item is approved. Item 6 is to approve the claims docket. I have a motion and a second. Please record your vote. Looks like it's hung up. There we go. I have a motion and a second. Please record your vote. Item is approved. Item 7 is to approve the following applications for service retirement. I have a motion and a second. Please record your vote. Item is approved. Item 8 is to approve continuation of pension to spouse. I have a motion and a second. Please record your vote. Item is approved. Item 9, receive report of death, authorize payment of the $5,000 death benefit, and authorize secretary to make necessary changes to conform on the following. We have a motion and a second. Please record your vote. Item is approved. Item 10, approve request of the following to terminate vested rights and commence retirement benefits. We have a motion and a second. Please record your vote. Item is approved. Item 11 is the receive the investment consultant report. Item 11A is the monthly investment report. And item B is the quarterly investment report.
I'm happy to step up now. I'm not sure if you're going to take the actuary afterward or if,
Did I skip an item? I don't think I did.
We received it as a consent item, but we didn't ask her to talk.
she's got nice little Post-its and notes, and I'm
She's
sure
re-
she's
all right.
ready to present.
Okay, well then let's go ahead and
Okay.
welcome Louise. Sorry about that. We just blew right through it.
That's okay.
No, it's not. We want to hear the actuary report.
Okay. Jason probably has better news for you.
I wanted you to tee me up.
Well, good morning, everyone. It's good to be here today, and it's good to see everyone on this beautiful Thursday morning in Oklahoma City. I'm happy to be here today and to have this opportunity to talk about the results of the most recent actuarial valuation of the pension plan. As you know, the actuary's job is to measure the liabilities of the pension plan. Having measured those liabilities, we compare them to the assets held in trust, and based on that comparison, we come up with the employer contribution to the fund. One that is sufficient that when coupled with appropriate levels of investment income will enable the fund to provide for all of the benefits that have been promised to all of the plan members. So one of our key findings is shown on page A-2 of the report. And Jason is right, I do have sticky notes, so I can quickly turn to each page of the report. So A-2. And what you see is the determination of city contributions to the pension plan for the city's 2026 fiscal year. So your pension plan it has a calendar year. The city's budget year, as you know, starts on July 1st and it ends on June 30th. So we do our calculations as of December 31st of each year, but it applies to an upcoming budget year for the city. This enables Brent and his team to have time to budget for upcoming contributions. So you can see at the top of the page, the contributions are shown as percentages. The city's computed contribution rate, the very last number in the top table, that rate is applied to payroll during the 25-26 budget year, which is, I think, a sensible way of providing for the contribution. I think it would be a better way in your plan than having us project payroll, and that's because your payroll, as you know, is somewhat volatile. When you look at what happened last year versus this year, and that's shown in the table at the bottom of the page, you can see that contributions have increased. And that may seem counterintuitive in a year like 2023, when most investors saw really good returns. However, the experience of the plan was not quite as favorable as what was projected, and we'll talk more about that in a moment. The second reason relates to the city's practice or policy of using surplus assets to reduce the city's contribution rate. That is a very common practice among public funds, and I think the rationale for doing that is that the city's bearing basically all of the risk for this pension plan. Investment risk, longevity risk, inflation risk, risks associated with pay increases. And so the city should get the benefit of good years since it's bearing the additional cost of bad years. So that's the rationale for doing it. But to the extent that you're using up surplus to reduce city contributions, it means that it's not available as a buffer for years when you have adverse experience. So you can see, looking at the table at the bottom of the page, that the number in bracket, the 0.53%, under fiscal 2025, that was the credit, so you're using the surplus to reduce city contributions. But at this point in time, the surplus is used up, and so now the difference between assets and liabilities is debt that you're financing. On page B as in boy dash 3, B as in boy dash 3, we have a summary of the revenues and expenses that occurred during 2023 in your system. This is an excerpt from your financial statements, and you can see a comparison between plan year 2023 and 2022. You can see that member contributions and city contributions of over 19 million, and as well as interest and dividends, are less than the benefit payments and refunds of contributions coming out of the fund. Now, that's not a source of concern, but what happens is that Jason and his team will liquidate some of the assets to bridge the gap. That is a very common situation in most pension funds these days. It's not a source of concern. You can also see, looking at calendar year 2023, that the fund grew by over $50 million. In fact, the net market value rate of return was 10.23%. Now, our measurement's probably a little different than Jason's because we subtract off not only investment expenses, but the plan's administrative expenses as well. So you may be wondering why we have adverse investment experience when the rate of return, exceeded the 7% bogey that we have in your fund. And the answer is shown on page B-4 of your report. So as you know, we don't use simply the market value of assets to determine city contributions. Doing that would create a great deal of volatility in the fund, and it would make it very difficult for Brent and his team to budget from one year to the next. So in a year like 2022, using market value to determine city contributions, you'd see a pretty significant spike. In a year like 2023, it would drop back down again. So to mitigate that volatility, we use a smoothed asset value, which is shown in quite a bit of detail on page B as in boy -4. And so B and C are the market value of assets at the beginning and end of the year. The funding value is the market-related value, and you can see that it's higher than the market value of assets. The reason for that is that when you have more investment losses in the pipes than you have gains, that smoothed asset value becomes inflated relative to market. And then the opposite is true. If you had more good experience that you were holding back, the funding value would be lower than market value. So what we're trying to do here is phase in differences between the investment income you received and what was expected, and that happens over a 4-year period. So item E shows the investment income that the fund saw, net of expenses, over 81 million. E2, E like elephant 2, would be what we expected the fund to earn. So you have an investment gain of over 18.4 million. and that gets phased in over 4 years, so we recognize 25% per year. But you can see, looking at item F, those are the pieces of prior experience in the current year that we're recognizing. 2022 was a horrible year for investors. The pension fund is an investor. You know, I have a 401k, I'm an investor. 2022 was a horrible year. And you can see that that large investment loss, over 50 million, it's kind of dragging down the investment returns from the other years, which were very good years. So when all is said and done, the rate of return using this smoothed asset method, it's 5.53%, and the bogey is 7%. Jason will probably have some good news for you for 2024, spoiler alert, and that will improve the situation going forward. Another source of adverse experience is shown on page B as in boy -8. So you see quite a few numbers here. This is a 21-year history of the census, the employee members, we call them active members of your pension plan, the inactive members, people that quit, vested, and are deferring receipt of pension benefits. And you see annual payroll and some other stats. If you look at the very last column, the percent increase or decrease in average pay, and you look at the last 6 years, you'll see that pay has been volatile, and in 3 of the 5 years, around 8%. So when we calculate the liabilities of the plan, we're using the data that's provided today, and we're projecting it forward to retirement to determine the retirement benefits of all the employees in the plan. When you have a spike in pay, those projected benefits become higher. That drives up liabilities, and if you don't have a drive up in assets, the employer contributions go up. So that's what happened this year. And it was a similar situation last year. But it's kind of interesting how volatile payroll is in your plan. And you can see that just looking at the very last column. But I think there actually is good news to report. On page A-4, Apple-4 of your report, we have another table that shows a 20-year history of retirement system liabilities broken out in columns 1, 2, and 3 by sort of category, and the total is shown in the column called total accrued liability, or total AL. You see the funding value of assets next to it. But I'd like to draw your attention to the very last column, which is the system's funding percent. So that's the ratio of assets to liabilities. And it's a very common metric used to measure the financial strength of the plan. And what you'll note here is that, like, at its lowest point in 20 years, your funding percent was 92%, which sets you far apart from what we see in most retirement systems. I looked up survey results for an organization called NCPERS, National Conference on Public Employee Retirement Systems. They produce this survey every year, and I'm always curious about what's happening in other retirement systems. They survey over 150 state and local plans each year. And the average funded percent for 2024 was, I think it was 75%. And for 2023, it was, I think, 77%. 78% in 2023, 75% in their 2025 survey. Your funding percents over the last 20 years far exceed that. So certainly good news relative to your peers, and an indication of the financial strength of the system. And I have, I think, just one other item.
So Louise, so in summary, we went from 101 to 98, but our contribution going for FY '26 is going to go up, the city's contribution.
Right, correct,
Okay.
correct. And so hopefully the funding percent improves next year with the great investment performance that Jason's going to share with you. On page A, like Apple-8, there is a new item in the report this year. The low default risk obligation measure, the LD-ROM. So as actuaries, we're bound by what are called standards of practice. And there was a change made recently, and it creates a duty for all pension funds to report this LD-ROM number. So when we measure liabilities in your pension plan, the discount rate that we use is based on expected investment return, long-term rates in the future. This requirement creates a duty for us to measure those liabilities using treasuries or a yield curve. And so you can see, just looking at the bottom of page A8, that when you do that, the value of liabilities goes up. It's going up because we expect less investment income in the future, which means you have higher obligations today. There are a couple of schools of thought about this. Some people think it's yet another criticism of public employee retirement systems because now you're posting this liability number that's much bigger than what people have seen in the past. The other school of thought is that it enables you to get a better sense of the investment risk that you're taking on as a pension plan, as well as, I think, what you're saving by having a diversified investment portfolio. This number doesn't show up on the city's financial statements. The only place it's reported is here in this report, and everybody has to report it. So that concludes my prepared comments, but I'm happy to answer any other questions that anyone may have.
Any questions this morning for Louise? Once a great report. We value having you with us
Thank you.
for the long run. So,
Thank you. Yeah,
thanks again.
my pleasure. Thank you.
Okay, we will return to item 11.
Okay, try this again. Could you pull up the quarter report? I'm sorry. So I have a couple of items. Since Louise said I'm going to come and give you good news, I'm going to talk about September, not October, because October was a down month. And then I'll tell you where we are in November. So the chart here on the screen just shows market returns for broad asset classes through the end of September. As Louise said, your actuarial valuation report is done once a year in December. So it really depends. Everything is very endpoint sensitive. Right now, as we look at these one-year returns, that one-year column, everything, that's not the one I wanted. Come back one. Every asset class, including fixed income, is up over 10%. The Bloomberg aggregate, which is U.S. investment grade bonds, up 11.5%. You have a 7% hurdle rate from an actuarial standpoint. Large cap U.S. stocks up 36%. Small cap, which is the Russell 2000, up 26%. International stocks up almost 25%. Emerging markets up 26%. So a very good one-year period ending September. On a relative basis, we've talked about this, the more U.S. large cap you have, the better you look. But on an absolute basis, your portfolio has performed how we would expect it to. You've gotten a good percentage of the upside. I'll just roll forward a little bit, touch on a couple things that have really impacted markets more recently. As we look at bonds, what this chart is showing is the interest rate term structure of treasuries. So on the far left side, this was effectively the Fed funds rate, the overnight rate. As you know, in September, the Federal Open Market Committee lowered interest rates, the Fed funds rate by 50 basis points, and then again by 25 basis points last week after the election. And so that Fed funds rate today stands at about 4.75%. What this chart doesn't show us, if you go down and look at the 10-year, and I'll look at the numbers, it's easier to decipher. At the end of September, so what is that, 6 weeks ago, the 10-year stood at 378. As of this morning, the 10-year is at about 440. So it's moved up about 60 basis points or 25% increase in rate. So longer-term investors are anticipating still, we continue to have good GDP growth, low unemployment that can potentially lead to some stickier inflation, as well as you heard Amundi talking about large federal deficits. So it's going to keep longer-term rates up. Historically, the 10-year Treasury should be at a premium to Fed funds. Longer duration bonds should be trading at a premium to short-term bonds. We've been in this inversion now for about 2 years. It appears that the Fed is navigating a soft landing. The economy continues to be doing well. Under normal circumstances, the 10-year trades at about 150 basis points above the Fed funds on average historically, which would mean if the Fed is looking to get Fed funds to about 3.5%, which that appears to be where they're targeting now, despite, unless something else happens that would force them to move rates lower, or inflation comes back and force them to move things up, that would mean that the 10-year needs to be at about 5 to be near the historical average. So not surprising seeing that movement. As we look at your portfolio results through the end of September, I think this is a good chart. It doesn't tie exactly to Louise's numbers because it's a different period, obviously, but it's rolling forward 9 more months. If you look at that 3-year column, this would be starting in October of 2021, or the end of September of 2021, before the market crashed in 2022. So the end of 2021, that was a good year from a valuation standpoint. Equity markets were at all-time highs. Fixed income yields were at all-time lows. What we saw in 2022, interest rates went up, bond values went down, and at the same time, equity valuations came down. So you had a big loss across the board. But the total portfolio stood at $934 million. We're not quite back to that at the end of September. At the end of September, the market value of the portfolio was $912.7 million. And so you see the portfolio you have a positive return on investment over that 3-year period of almost $78 million, and net outflows of right about $99.8 million. So that's payments, expenses, and benefit payments to participants. We would expect that to be a negative number. 5-year number, pretty strong, $318 million. The 1-year, very strong return in that 1-year period ending September. Year to date, you've grown the assets by about $76 million. So we're tracking, and you'll see this in a minute, for the next endpoint, December of this year, hopefully is tracking above that 7% number. Year to date through September, it was a little bit below. We've had a good October, as I said, was a down month, but we've had a good November so far. This is just looking broadly at the portfolio results over time from both a risk and return standpoint. So from a return standpoint, those top a couple of measures. We're looking at 5 and 10 years. The portfolio has significantly, as of 9/30, outperformed your hurdle rate of 7% by about 100 basis points over a 5-year period and about 30 basis points over 10 years. The one thing, when you look at your funded status and how consistently, I'd say strong it's been, close to 100%, you've been very good stewards of capital and being conservative in your approach, lowering that hurdle rate to 7%, which is about where the national average is now from that survey data. But we work with a number of clients that have slowly moved that down, because what it does, it increases the city's contribution. But that helps in keeping that funded status strong. The other things I'll point out from a risk standpoint, and this is just philosophically how this portfolio has been constructed, we're trying to get these returns being cognizant of risk so that we're not down as much when the market is down. And these last 3 items there, volatility, beta or sensitivity to direction of the market, and then down capture, were all lower than the market, meaning you have less risk in the portfolio than the overall market, which is what we're trying to accomplish. From an asset allocation standpoint, I'll point this out because we did do some significant rebalancing in the month of October. You'll see here at the end of September, we're about 3% overweight to equities, a little bit underweight to fixed income and real assets. The majority of the overweight in equities was on the U.S. equity side, large cap, because it's done better than everything else, and then U.S. small cap overweight. We rebalanced in the month of October, $35 million from large cap that went into international, and what number I have it here. 15 million from small cap from Earnest, and that went into fixed income. So at the end of October, pretty much on top of the broad asset class targets, equity, fixed income, and real estate's a little bit underweight still. Just gonna,
Jason,
Yep.
I was, after our meeting yesterday, I was talking to one of my associates, and we were in the office, and we were talking about when to reallocate, restructure, everything. He said he had heard that you should do that somewhere between 2 years and never. You ever heard that?
rebalancing.
Rebalancing, yeah. He said,
Well, for a pension, we don't have to do it very often like we just did,
right,
because you are regularly rebalancing in smaller increments
right,
because of cash flows.
okay,
So that generally leads to not having to do a big
whole big
rebalancing like
rebalance.
we just did very often, unless you change target allocations. So what's happened now is just large cap has outperformed everything over the last year, decade, that were a little bit out of whack. So, but generally, a pension plan is rebalancing every month
okay.
because you're raising money for, you have to.
That makes
To
sense,
raise money for operating needs. What I'll point out here, and just to tie back again to a meeting we had yesterday, looking at this portfolio over a 10-year period, that the light blue square is your portfolio, and that 10-year risk return indicating you have more return than the policy benchmark with less risk. And that's ideally what we're trying to accomplish. And we know there's going to be periods of time where we're a little bit behind and a little bit above, but hopefully we're getting to a similar place with less risk. On the benchmark relative to statistics, up and down capture on the right side, and this is looking at a full 10-year period, the up capture, 94%. What that means is if the market's up 10%, you're capturing 94% of that upside on average. When the market's down 10%, we're capturing about 91% of that. So we're down less. Over time, if you think about the simple equation, if you have $100 and you're down 25%, you got to be up 50% to get back to square one. So we want to lose less when markets are down to compound the assets at a greater rate. Mayor, if you could flip to the October report. Thank you. So as I mentioned, October was a down month. This doesn't really reflect that, but a couple things, and we already looked at this. This is rolling forward 1 month. I'm going to just quote you some numbers because it's pretty astounding what we've now seen through the first few weeks of November, really after the election. And it's not unusual to see, I think we have this chart. Oh, right here, yep. What this chart here is showing is historical election year volatility in the markets. And typically, increased volatility is an indication that markets are down. When volatility in markets subsides, markets tend to go up. Historically, we've seen an increase in volatility moving into elections, and then following an election, regardless of result, volatility tends to come down, and we tend to get better market returns after an election. And this year didn't deviate from that pattern. We saw a very volatile month of October leading into the election, also with rates, short-term rates coming down, longer-term rates coming up. That put pressure on stocks, and we saw and bonds, seeing things go down. What I wanted to point out here, and it's not shown here, but if we roll forward to yesterday, small cap on a trailing 1-year basis is now up 41%. So just adding the first 2 weeks of November, small cap is up 41%. Large cap on a trailing 1-year basis is up 37%. So we've seen small cap overtake large cap, at least on a trailing 1-year basis. I think we showed this slide to you a couple months ago. Generally what we've seen when Fed starts lowering rates, that tends to be good for equities, and small cap tends to lead the way when the Fed starts lowering rates. A lot of that is probably baked in already. A 41% trailing 1-year return in small cap is very strong. You'll see here at the end of October, target allocations basically in line, a function of that rebalancing, still a little bit over to equities, slightly under in fixed income, and slightly under in real estate. But the overweight, this was 24% large cap, that came down. This was 14%, that came down, and now we're almost at the target in international. We had another month where U.S. outperformed non-U.S., so that contributed to that. Any questions on the monthly or quarterly report before I move to the fixed income?
Okay, hearing none, we will go ahead and take a vote on item, I believe it's item 11. Okay, Chair will entertain a motion on item 11A to receive the monthly investment report. I have a motion and a second. Please record your vote. Item is approved. And we need a motion on item 11B, the quarterly investment report. I have a motion and a second. Please record your vote. Item is approved. We'll move on to item 12, which is items for individual consideration. Item 12A is fixed income portfolio discussion.
Okay. There we go. Thank you. So this, rehashing what we presented last month in follow-up to the presentation from Amundi Pioneer, we put in the back, in the appendix here, the issues with WAMCO. I'm not going to rehash them unless anybody needs me to, but significant team turnover, regulatory investigations, we think there's other alternatives that we should consider. In so doing, when we looked at that, this is how we've defined your fixed income allocation today. 5% target to core bonds, which is the SSGA passive strategy, 15% to multi-sector, but that's really implemented right now through two distinct managers, WAMCO, which is a core plus strategy, and Brandywine, which is a global bond strategy. And then 5% to the unconstrained PGIM strategy to make up the total portfolio. What we proposed last month was looking at a single manager in Amundi Pioneer to be that multi-sector piece. And as we look at it from a quantitative standpoint and qualitative, the historical results are just a little bit smoother. And I think that as they described it, they're tying everything together. It's not distinct decisions being made by two different firms. And as we look at this, if we go to, I can control it here. I think this page is helpful. What we're showing here is the index, the aggregate bond index, which is what we're trying to ultimately outperform. And we're doing that by utilizing managers that have the ability to do some things outside of the benchmark, particularly in high yield, bank loans, non-US, and other categories. The current portfolio is this structure that you have today with these four managers. The alternative portfolio would be replacing these two with one. And what we're looking at is what the characteristics ultimately look like. And it doesn't change dramatically, and I think this is what's important. It actually, the duration's a little bit lower, so a little bit less interest rate sensitivity right now. A big part of that is because Brandywine, as a global bond manager, dedicated global bonds, has a much longer duration. So we're taking out some rate sensitivity there. The average credit quality stays about the same, still investment grade, single A. And this is a point in time. A little bit more high yield, a little bit less treasury. Again, you're taking out a global bond manager that's primarily government bonds, and that's what's bringing down the treasury exposure. The non-US and emerging, about the same. We're still getting that exposure to non-US and emerging. The other that you see here, these are Yankee bonds, which are non-US corporate bonds that trade in dollars. Some 144As, which are corporate bonds that aren't rated. They're privately evaluated by the fund managers, so they're corporate bonds. You're getting a little bit more of that, but it ultimately looks pretty similar. The proposed vehicle is a collective investment trust. We've negotiated a very good fee. First $50 million at 30 basis points, the next 100 at 25, which is a little bit better than their standard terms. And go forward to just the performance comparison. So what we're doing here is just what we're swapping out for what we would potentially be swapping in. So roughly this multi-sector piece is 2/3 Western, 1/3 Brandywine, and this is backward looking. So you'll see on a 1, 3, 5, and 10-year basis, just the Amundi Pioneer strategy outperformed that blended strategy over all those time periods ending 9/30, and did so with lower volatility, standard deviation over the 3-year, about the same, and a 5-year, and 10-year, a little bit lower standard deviation. Up and down capture numbers, which we just talked about from a portfolio standpoint, I'd say that this profile over 10 years, you're still getting the upside, not as much as we got with this combination, but you'll see this down capture, pretty significant down capture. It's taking that off by quite a bit. You're protecting. They actually protected when the market was down 13% in 2022. They were down, the strategy was down, but not nearly as much. And then just looking at rolling periods, I think this is pretty compelling. These are distinct 3-year rolling periods ending September. If we go all the way out here, this would be the period really from 2012 to 2015. That's 2013 to 16. You'll see every 3-year period, with the exception of one, this strategy outperformed both the ag and the combination of what we have. So based on just the issues that we're experiencing at WAMCO, as we revisit just the overall structure, our recommendation would be to replace both of those managers with the Amundi Pioneer multi-sector strategy.
Anyone have any questions? Hearing none, Chair will entertain a motion on item, what item is that? 12A1, authorize termination of Brandywine and Western Asset Holdings in order to reallocate the proceeds to Amundi. I have a motion and a second. Please record your vote. Item is approved. On item B, I'm not going to read the entire title of that resolution. I'm going to ask Gina and possibly Brent to maybe just give us a 30,000-foot overview of what this does, just so everybody can have a little better understanding before we vote.
Sure. Good morning. What this is we're in the process of restating our plan documents for the 401 and 457 plans for the city. And so we're still in that process, but we're going to need a participation agreement for the employees of the system to be able to have these plans. Mm-hmm. And so this is giving authorization for the chair to sign these documents once they are ready, after they've been approved by City Council. And then the other portion of that is there's some pickup language that needs to be declared, which is the employee contributions are taken out pre-tax, and so the employer has to pick them up to pass them on to the carrier. So it's not going back out to the employee. There's tax implications that way since they're pre-tax, and so it's just making that affirmative declaration that that's how we handle it, and we handle it currently that way.
Okay. Any questions? I know that both Gina and Brent have put in a significant amount of time working with Cindy Burley, the system's tax attorney, on this, and this is the result thereof. So, not hearing any questions, Chair will entertain a motion on item B. We have a motion and a second. Please record your vote. Item is approved. And finally, item 13 is any comments from board, staff, and citizens? Hearing none, we are adjourned at 11:07. Thank you, everyone.